loads of bonds in that type of situation. To buy bonds, you've got to buy US dollars. So you buy US dollars to buy into that real yield storyline. The challenge you've got, of course, is that we want to make sure the nominals are with us as well. But the challenge we've got with the nominals, of course, is that the nominals are either cheap or expensive against the full curve. If nominals are cheap against the full shape of the curve, it's very easy to buy dollars, very easy. As soon as the nominals change, we buy dollars. Very, very, very easy trade. But the nominals aren't cheap against the back end of the curve, are they? They're very expensive against the back end of the curve. So it's very difficult to be long dollars. So we've always got to make sure we demand a really good discount. Do you all understand what I'm talking about? I think everybody gets it, yeah. Good stuff. So when we're looking at the shape of the markets, of course, if this is nominals, there's two ways we can look at nominals, isn't there? There's two ways we can always understand nominals, and it's about where they are in relation to the cycle. If we look at nominals against the, for example, the back end, obviously we always look at it against the back end. Why? Because, well, that's what you always do with nominals, don't you? You always look at it in relation to the back end of the curve. We know that there's a lot of things that can happen, of course, but usually we're going to be seeing maybe some events like this, for example, here. So without looking at a storyline of real yields, this is telling us where we can do business. Where's the best place to buy dollars? Okay, let's just put some areas onto your screens. Where's the best place to buy dollars? Best place to buy dollars, of course, must be in this area here. Yeah? Best place to buy dollars must be in this area here. Yep. Best place to sell dollars must be in this area here, correct? These must be the best places to buy and sell dollars because we've got the right ratio, we've got the right narrative, we've got the right setup here on each of these dollar trades. The reason for that is very simple. The drive lower here on the nominals would suggest that the dollar should be massively discounted into a bottom edge. The drive higher in the nominals and then the weakness in the back end of the curve suggests the dollar should be massively premiumed into the top edge. The drive lower in the nominals suggests the dollar should be very cheap into the bottom edge and a big discount into a buy trade here. Does that make sense? Everybody got that? So when we think about that as a storyline, if I take off real yields for the time being because it's not relevant to the storyline, one of the things you'll be able to recognize in this type of storyline here, sorry, the colors are slightly different, but nominals are in red and nominals are in red, back end of the curve. In this case, the back end of the curve is the knob spread are in blue. Where's the best place to buy dollars? Where's the best place to sell dollars? Well, if you follow what I've just been talking about, the best place to buy dollars would be in any turn up here. Any lower low in here, for example, any lower low in here would be the best place to buy dollars, yeah? Everybody happy with that? Where would be the best place to sell dollars? Well, of course, with the turnaround here, the best place to sell dollars would be here. The best place to sell dollars would be here. The best place to sell higher dollars would be here, correct? These are all the best place to do business on the dollar. So if that's the case, what's the best dollar trade at the moment on a macro scale basis? Well, we can see on a macro scale basis, the best trade is to be selling dollars, of course, at higher prices. But what if the dollar's at lower prices? What if the dollar's down into bottom edges? What if we're seeing that bottom edge price? Well, we know that the dollar should be a lot higher because of nominals are a lot higher. However, it's in the wrong relationship at the moment. It's a short-term relationship, isn't it? You might be saying, what do you mean it's a short-term relationship? Well, of course, this is a 15-minute chart. So obviously selling macro dollars is the right trade, but buying micro dollars is the right trade as well. Selling macro dollars is the right trade, buying micro dollars is the right trade. Would everybody agree with that? So what do you mean by buying micro dollars? I don't get what that means. Well, let's take a look at micro dollars. Let's go down into, for example, a 5-minute chart and zoom into the narrative. So we've got a basic idea of where we should be selling and buying dollars. If we come down into a 5-minute chart and we zoom in a little bit, of course, life changes. Let's take it down a little bit further so that we get a better idea about what I'm talking about. 2-minute chart. Life changes, doesn't it? Because here we go. So we're now on a 2-minute chart. Does everybody see where the micro buy is on dollars here? If we get lower prices, if I take you off of that area here, can you see where the micro dollar narrative would probably be playing out here? So there's all these micro narratives, isn't there? There's always a micro narrative to every macro. Sometimes it lines up with a macro, like this trade here and this trade here lines up with a macro. This trade here doesn't line up with a macro, but now gives me a micro strategy that I can play. If I get a discounted dollar, I might not get a discounted dollar. But when those micro and macro strategies line up perfectly in line with each other, we execute, don't we? It's just as simple as that. We execute, we get into the trade, we start doing business. So when we start to think about these ideas of micro and macro, we're trying to make sure we don't lose sight of the fact that there is always two perspectives, there's always two contexts. There's always two contexts to every trade we take, correct? So this is what we've got to remember when we talk about these as narratives. You've got to make sure you know what your own context is. There was a question asked this morning about the Aussie dollar. And the answer was very simple. It depends on the time frame of analysis. We did the time frame from the 30 minutes to the 15 minutes and were able to answer that question. But if the question wasn't based around those time frames, the answer might be completely different from what you're looking for. If your time frame of analysis is a daily chart, my 15-minute answer isn't going to be accepted. It's not going to be a reasonable answer because it doesn't make any sense. So this is what we've got to try and remember that we do when we look at these markets, is we put the context together. If this is discounted to the 10s, 30s, this has upside room. If it's premium to the 2s, 30s, it doesn't. It's going to drop down and rotate, isn't it? It's going to have that constant kind of rotational feel about it. And that's where we have disconnects with your ideas of what you should be doing and the ideas of what you on a macro scale versus what you should be doing on a micro scale. So we've got to be able to work into these as ideas. So when we look at this as a chart, on a 2-minute chart basis, take a look at the dollar and see what you could have seen as possible trades. Obviously, the dollar has to be premiumed against the 2s, against the 2s, 5s. So the dollar was premiumed against the 2s, 5s up here. So that could have been a trade narrative that you might have been interested in selling down into right there. But obviously, we would have needed to have seen a very, very definite drop in the 10s, 30s at that stage. And the 10s, 30s only started to drop here. So that's quite a tough call to sell that dollar just there, but you can see that's the only trade you would have been looking at. And when it starts selling off here, you start thinking to yourself, right, I'm going to try and get into that sell trade after the sell as it starts to drive lower. Now, obviously, when it turns here, you can see there was a nice opportunity to buy some dollars. I bought some dollars, scratched out of the dollar position. I bought some dollars in here, scratched out the dollar position. This drives down, this drives up, and that puts some sell pressure back into the dollar, as you can see. As this starts to turn back up again, guess what we're doing? As this starts to turn back up again, guess what we do? We start buying more dollars into the lower price. But remember, this is working against the macro. The better trade is to try and get into the short bit of business at higher prints, because that's what the macro is. The macro in this case is like a 15-minute chart. And we can see in the 15-minute chart that the easier trade on a 15-minute chart is to be selling at premiums to the nominals, selling at premiums to the nominals. So when we're selling at premiums to the nominals, you can see we don't really ever get a premium to the nominal. But take a look at what happened at the bottom edge of the dollar here. See this trade here? Do you see how that trade worked out for you like an absolute crackerjack in here? Look at that buy trade there, nice pop. Into a lower price, nice pop, and look at the big picture in the background. The 2s, 5s has a lot of room to go higher. That's what we're looking for as traders, aren't we? How much room in this current example has the 2s, 5s got to go higher? Kind of limited to short-term moves, isn't it? Do you understand what we're saying? Kind of limited to short-term moves because it's already killed the back end of the curve. So because the 2s, 5s has already killed the back end of the curve through this whole sequence from today's open, we can now recognize the fact that the 2s, 5s really is going to struggle to make much more gain to the upside. If the 2s, 5s is going to struggle to make much more gains to the upside, the dollar's going to struggle to make many gains to the upside. And every time we head into those macro top lines, as soon as we head into those macro top lines, the sellers come in and sell it. The macro's top line, the sellers come in and sell it. We always look at this as the process. Yeah, it's just convention, Logan. When we're talking about the 10s, 30s, we're talking about the 30-year minus the 10-year yields. When we're talking about the 2s, 10s or the 2s, 5s, we're talking about the 5s, 2s, 5s minus 2-year yields. It's just the convention for it. I know it's a pain in the arse because it's effectively the wrong, it almost sounds like it's the wrong way around. But when we're talking about the 2s, 10s, we're talking about the 10s minus the 2s. 2s, 10s is obviously the front end of the curve. The 10s, 30s is the knob spread, 30-year yield minus 10-year yield. So it's a little bit annoying. It's a little bit annoying. It's back to front, basically. We're doing the actual trade. We're doing 3x2s on the 3x2s on the 2s, 5s in red, and we're doing 3x1s on the knob spread in blue. So the 3x1s is a knob spread, and the red line is the 2s, 5s on a 3x2. And obviously in these types of situations here, this is where we want to do dollar business, which is why the dollar's been an easier sell than it has been a scalp buy. So we can scalp buy it, macro sell it, scalp buy it, macro sell it, scalp buy it, macro sell it, as long as we like, because that's what we obviously can understand. We want to be buying at lower prices if it gives us a big macro against the 2s, 5s, but we've still got to try and find the ability for the 2s, 5s to make some gains. And if the 10s, 30s is getting murdered, that gain it's going to be limited, guys. It's going to be limited. We always got to remember that. So there's a little subtle nuance that we have to add into our knowledge base for these to be successful, haven't we? We've got to add that nuance into our ideas when we're looking at these trades.